and welcome to this episode of China Edge, brought to you by the SupChina team. I'm your host, Lizzie, an MIT-trained economist turned journalist at Wall Street TV who covers China and its relation to the world. Here at China Edge, we go beyond the headlines and guide you, our audience, through the jungle of Chinese regulations. We go deep into industry trends and identify challenges and opportunities in the Chinese market. Join our conversation every week for interviews and analysis with the most knowledgeable minds on China. Also, stay tuned for special panel sessions with Kaiser Kuo, host of the Sinica podcast, and Jeremy Goldkorn, editor-in-chief of SupChina. China's economy is facing significant headwinds this year, but have consensus forecasts adequately accounted for the extent to which the Chinese economy is slowing, or the likelihood that growth slowdown will continue well into the future? Joining me today is Mr. Logan Wright, partner at Rhodium Group. Logan, thank you so much for being here with me.
Thanks, Lizzie. Good to be with you.
So Logan, in a recent set of notes, you wrote, quote, "Our view on China's growth rate in 2022 are clear. We are headed for very low growth this year, at the most 2 percentage points, if there is dramatic rebound in the second half, and a recession or economic contraction for the full year is becoming increasingly probable." So I'm going to start by asking you to sort of walk me through the data or reasoning behind that conclusion.
Sure, happy to do so. So basically, the argument is that ultimately it's going to be, if China is going to see a source of growth from an expenditure side component of the data, when we think about household consumption, household and government consumption, business investment, and then net exports, it's likely to come from the consumption side only. We're highly likely to see contractions in overall investment or negative growth in overall investment and a slowing contribution of growth from net exports. Mm-hmm. The reason for that is largely about it's even separate from zero COVID policy on the investment side. You have zero COVID that's restricting basic economic activities, services sector activity, employment, and income growth, obviously having an impact on household consumption as well. But in underlying all of this has been a very significant slowdown in the property sector. And the property sector has historically been a very important driver of China's overall investment growth in recent years. But undoubtedly, that contribution is going to be negative this year. And then it's a question of whether other sources of investment growth from the government's effort to boost infrastructure investment or from other sources of private sector investment are going to offset that slowdown in property investment. We would argue they are very likely not going to close that gap. So you're still likely to have negative full year investment growth on an expenditure side basis this year. How large a downturn in investment is still up for discussion, but right now property sales are down between 30 and 40% nationwide for the full year. And this is a very significant credit crunch that has been delivered to property developers. So over the last year, property sales were 18.2 trillion renminbi, and that was roughly 16% of GDP. This year, if those revenues are down 30 to 40%, that's a hole of 3 to 4% of GDP that's very difficult to offset with policy. So on the investment side, we're likely to have a negative contribution to overall growth in 2022. On the net export side, we are also likely to have a negative contribution. And that's because China had a record trade surplus last year because they continue to expand global export market share. This year, export orders are already falling. Port throughput and container port volumes from major ports have been slowing due to zero COVID related policies and restrictions. But export orders from some of the PMI surveys have already been drying up for 8 or 9 months now. And with that in mind, along with the rise in commodity prices and the likelihood of a narrower trade surplus, you're likely to have a negative contribution from net export growth overall, primarily because of the slowdown in actual export volumes. So that leaves consumption and household consumption. And what we're finding right now is that a lot of the evidence points to very weak consumption growth, if any, and the possibility of what's being discussed in China as a household balance sheet recession, meaning that households are refusing to take on new credit, particularly in the form of mortgages, linked to the slowdown in property sales, and therefore are choosing to pay down existing debt rather than spend more or invest more. The PBOC's own quarterly surveys on what households are inclined to do. They conduct this quarterly survey virtually every quarter, saying, would you like to invest more, spend more, consume more? And the proportion of households that is indicating that they want to save more is now at an all-time high within that survey. So it does indicate that there's a lot of caution among household consumers. Even Alibaba online sales, for Taobao and Tmall have posted 20% plus declines in recent months. This is indicative of a very weak consumption impulse. It can certainly rebound later in the year. It probably will, if COVID-related restrictions are lifted. But that probably does not amount to a very rapid rate of overall growth, much faster than what had been taking place in previous years. And that's why we think that it's, a very low single-digit rate of growth is the far more probable ceiling of what China can reach this year. And it's quite possible that you could have zero growth or a recession.
Right. So I wanted to circle back to that question on policy support a little bit. In the past, when the Chinese economy was under stress, the government was able to flood the economy with cheap credit, basically, to prop up the economy. Why is this time different? Why is policy support unlikely to be able to support the Chinese economy this time around?
Well, there's a few reasons. One is that there's only so fast you can expand. There's only so much you can expand the financial system as an offset to fundamental economic weakness. So, in the last decade, the financial system has grown much faster than the real economy, and it's essentially served as a shock absorber for the economy. So, even if certain businesses and economic activity should have been shut down or firms should have declared bankruptcy, they were still allowed to maintain access to cheap credit. And therefore, they could continue producing, continue employing people, maintain GDP growth at a relatively high rate. So that is really no longer possible because the financial system is already has assets equivalent to around half of global GDP. It's been expanding, much faster than the real economy over time. And simply continuing that same pace of credit growth would require, extraordinary volumes of funding of new credit. If you were going to run Chinese credit growth at just 15%, if the banking system is a little over three times GDP, that means you're looking at roughly half of GDP, or something like $8 to $9 trillion in new credit, just to maintain the previous average rates of credit growth. It's very difficult to fund that kind of expansion. The second reason is that policy support is just less effective because of the slow pace of structural reform within China's economy in recent years. So the IMF estimates China's productivity growth, TFP growth over the last decade has been around 0.7%. Others have it close to 1%. And when you're relying upon the same old growth drivers of property and local government infrastructure investment, you're not going to get the same output or the same marginal benefit from new credit expansion. Right now, credit demand is extremely weak within the economy. So there's very few, both households and corporates, that feel the need to borrow in order to fund additional investment, given some of the weaker economic prospects out there. And we can see that through high frequency data such as bill financing rates, which have declined very close to zero in recent months, which indicates that banks are actively sort of bidding for assets to dress up their balance sheets rather than being able to find ready borrowers within the financial system.
Forecasting for GDP growth in 2020 is very slow to adjust, and you actually wrote about that in that set of notes. Is code of silence among sell-side institutions when it comes to Chinese data. I wonder if you can elaborate a little more on that code of silence.
Sure. I mean, I think it's been unrealistic for the problem with Chinese data. I would say you have sort of the 6-month or 1 year problem, which is what's happening right now, in that the GDP data haven't really reflected the extent of the slowdown from the property sector in particular over the last couple of quarters of data. So we can talk about some of the specific complaints we would have about that short-term anomaly. But the bigger problem, and for the credibility of Chinese data, and where the idea of omerta, that nobody's really talking about this, came from, is the fact that from 2012 to 2019, over an 8-year period, year-on-year GDP growth barely moved outside of 1.5, 2 percentage points overall. That is historically unprecedented. Definitely over an 8-year period, and from the 4-year period from 2014 to 2014 to 2018 to 2015 to 2018. The volatility of GDP growth was even more stable than that, and which is also, historically highly improbable that you would have that kind, given that most of Chinese output statistics, a lot of financial market development showed a real economic cycle that took place, particularly with a notable slowdown in 2014 and 2015, and then a pickup in growth in 2016 and 2017 before another sharp decline in 2018. Against this, why is there sort of a code of silence? Well, if everyone knows that Beijing is not going to report dramatically different data relative to, and is going to continue to report a very stable data series, it becomes a question of how far out of consensus does any individual forecaster want to become. And for those institutions that still need to work with Chinese clients or work with the Chinese government on official matters, it's probably not worth the trouble to start to stake out a very strong position that the economic data is simply distorted, when it is arguable the extent to which it is distorted. And it's a more complex debate, but this is why independent researchers like us point out some of these discrepancies where everyone acknowledges, I think, that there's a lot of smoothing going on and that there are some distortions in Chinese data. It's just debatable the extent to which they occur and how meaningful that is for the overall outlook. So that's where we are right now, because in zero COVID policy, for example, it's obvious that these are not minor economic adjustments. We had freight traffic decline by over 50% nationwide at the worst of the trough in late April. In early May, we've had property sales decline by 40 to 50% nationwide. We've had car sales down by 47% in April. We've had excavator sales down 61%. Alibaba, Tmall, and Taobao sales, as I mentioned, were also down to 20% plus in the last few months. These are not minor adjustments that can easily be smoothed over. These indicate significant contractions in overall economic activity.
I wanted to go back to zero COVID policy a little bit. As we know, lots of the slowdown now is related to zero COVID policy. So a line of argument would go, oh, we know the slowdown is really manufactured. Once China axes its zero COVID policy, everything is going to be back to normal. What's your reaction to that argument?
Well, to a certain extent, that could be true if you could send a signal that zero COVID had truly ended. But there isn't going to probably be that signal. There's probably not going to be a big announcement that all of these measures are going to be relaxed and changed, because there's still considerable concern among authorities that you could still have a widespread outbreak of the virus, and vaccination rates among the elderly are still not as high as they hopefully could be to try to prevent more infections and more severe cases of the virus. So I think that you're probably not going to get that widespread relaxation, and it's the uncertainty about whether lockdowns will be resumed or whether similar kinds of restrictions will come back into the economy that are having an impact on investment appetite and consumer appetite to spend as well. So unlike 2020, when I think that there was a widespread expectation that lockdowns and controls were temporary. Once cases were truly at a low level, this was just a matter of waiting to open up. And in 2020 and 2021, China's economy was generally quite open in terms of the rebound from the initial controls in the spring. We're probably not going to get that same degree of clarity this year, and the rebound of the economy is going to be constrained by the weakening export sector, by the property sector, and by some of the uncertainty about COVID policy in general.
Right. And speaking of sort of the longer term effect of China's mid to long term slowdown, as you point out in the notes, it's beyond the border of China. So tell us, what are some of the spillover or global macro effects of China's mid to long term slowdown that people should take notice?
Yeah, I think that no one's really quite prepared for that. If you look at the Bloomberg consensus on GDP growth this year, it's still at about 4.5%. And that's probably still far too high. I mean, we stated our own view, but even if even if we're wrong and actual GDP growth is slightly higher than that, I think there's still going to be a considerable adjustment of expectations relative to that sort of 4.5% consensus. And when you think about global growth dynamics over the next couple of years, the expectations for Chinese growth in 2023 and 2024 are still a bit north of 5%. And the question becomes, where is that growth going to come from? What sector is really going to drive it? And how are you going to get that growth powered essentially by consumption alone if investment continues to be a drag because of the slowdown in the property sector specifically? The property sector has been considerably overbuilt in the last decade as a whole. And that adjustment in construction activity is going to be a multi-year process. Whether it's a 2-year process or a 5 to 10-year process will essentially depend upon policy and how and whether sales come back. The implication, I think, is that China is likely to be a source of weaker commodity demand overall for the global economy over time. There's probably going to be an incentive. There's going to be weaker industrial production and activity in China. Also means probably, depending upon how coal policy and energy policy evolves, weaker carbon emissions from China, faster movements toward the peak of Chinese carbon emissions, consistent with China's population peak, which will happen, this year or next year, depending upon how how the data comes through, along with speaking into this current debate about global inflation. And I think that ultimately inflation expectations will be dependent upon expectations of global growth. And if China has been a considerable contributor to global growth in recent years, and all of a sudden those expectations are downgraded, that's likely to have an impact on how much demand pull inflation globally is really likely to result. So I think all of those are meaningful considerations in terms of how to think about the downgraded Chinese growth expectations, the implications for the global economy. Not all in negative terms as well. Certainly, when you think about the net impact and the potential slowdown in carbon emissions and inflationary expectations, for example.
Mm-hmm. Right. And, lots of our audience are from the investment community. They're currently pretty nervous about China. What's your advice to those investors who are currently on the fence between staying versus pulling out of China?
Well, I mean, I think investors have had to grapple with new risks this year, and that's the real difference. And so in the past year, we've had new policy risks. We've had a regulatory tightening campaign, the emergence of common prosperity, and all of a sudden, the expectation that a technocratic Chinese policymaking apparatus was giving way to a more politically oriented, policymaking structure is a brand new risk that investors have to consider. All that being said, yes, there was a flow out of equities from foreign investors, but bond market inflows continued, throughout the last year, despite the regulatory tightening campaign. It's only been this year when there's a number of factors tied to China's perceived alignment with Russia, zero COVID policy in particular, and the narrowing of yield spreads with U.S. Treasuries that has caused investors to be far more cautious about the Chinese bond market. And recently, we just had very significant outflow in May. Throughout the first 5 months, we've had a reversal of those inflows. So with investors, needing to consider those, for both equities and bonds, you have different sets of risks. Foreign investors are basically looking at this trade-off between, how much additional benefit do you get from investments in Chinese securities relative to risk-free assets elsewhere in the world, and second of all, is there a realistic growth path toward a resumption of growth or a path toward additional structural reform of China's financial markets that would make it easier to invest? And so those are just some of the considerations that everyone needs to weigh at the years ahead. I mean, it seems difficult to argue that China is going to continue in this path indefinitely. And usually when you see roadblocks ahead to reform and opening, you also see paths designed to break those roadblocks and to rekindle the start of reform as well. It seems improbable during times when you've had a lot of politically driven decision making, but it also seems improbable that China would just continue on a course that looks like it's headed for very slow growth and economic stagnation as well. So all of these questions are really in the balance right now in terms of foreign investment in Chinese financial markets.